Hello everyone, I am Pratap here. We are at part 2 of lesson 15. This is a practical lesson. In this lesson, I would like to provide 3 examples related to monthly income trade and weekly income trade. I am also going to explain how to calculate risk reward automatically by using the tools provided by the Tradingview. Tradingview has provided 2 tools, long position and short position. And by using both these tools, we can calculate the risk reward. And this lesson is having dependency on the earlier lessons. In case if you did not complete the earlier lessons, I request you go to NeoStock YouTube channel. There you click on the home page and then scroll down to the playlist Supply Demand Zone Price Action course. So click on this playlist. You will be able to access all the training videos starting from lesson 1.1 until the most recent lesson. All these lessons are available in an order. So please go through all these lessons one by one and then you can get into this practical lesson. I am also providing the link to this playlist in this YouTube video description. By clicking the link, you can directly get into this video page. And you can also find the links to all these video lessons at our Telegram channel, and from there also you can access. I am also providing the Telegram link in this YouTube video description. So please make use of this opportunity and strengthen your skills related to supply demand zone price action. So let us get into the practical session. The first example is about MIT trade, monthly income trade. You already learned in monthly income trade, the HTF time frame, the higher time frame HTF is monthly, the ITF is for weekly, and LTF is for daily. These are the 3 time frames you need to draw the zones, and you need to identify the location, you need to identify the trend, and also you need to identify the price direction. So let us start our analysis from monthly. Always you need to go from higher time frame to lower time frame. Always you have to remember this technique. First you need to draw the zones at the higher time frame. What is our higher time frame here? Monthly. So in the monthly we identified a monthly demand zone and a monthly supply zone. So this is the monthly demand zone. So we have a drop, we have 4 base candles, and then we have a rally candle, drop base rally. So we have drawn a demand zone here. Similarly, we identified a supply zone, rally base drop. So this is a monthly supply zone. So what is the primary purpose of monthly supply and demand zones? The primary purpose is identifying the locations. You already learned this entire, the distal line of the monthly supply zone to distal line of the monthly demand zone. You divide 3 equal parts. One is low on the curve, another one is equilibrium, and another one is high on the curve. So we have already divided into 3 parts. So you already did this exercise earlier. That is one purpose, marking the locations. And the second purpose is identifying the price direction, primary price direction. So what is the primary price direction here? How prices are moving? Prices are moving from monthly demand zone to monthly supply zone. Did the prices reaches the monthly supply zone? No, they haven't reached. At present, prices are located at the equilibrium. They are just about to cross equilibrium, but they haven't crossed. After that, they will be entering into high on the curve, and after traveling prices travel some time after, again it will reach into the monthly supply zone. Once prices reaches to the monthly supply zone, the pending orders in the monthly supply zone will push the prices down. So that is the way the price direction will be changed from monthly supply zone to monthly demand zone. This is what going to happen in the coming days. But at present, the price direction is monthly demand zone to monthly supply zone. Because monthly is the higher time frame, this is the primary price direction. So we have already identified primary price direction is from monthly demand zone to monthly supply zone, which indicates the bullish trade setup. Not only this one, even the trend also plays. The trend also should be uptrend. That is also important. And monthly time frame, we can also identify the supportive trend. The primary trend is at the intermediate time frame, but the supportive trend for bullish trade setup, we will also use monthly. On monthly, for bullish trade setup, the trend should be either sideways or uptrend. At present, monthly trend is uptrend. How can we say monthly trend is uptrend? Already we have a drop, base, drop, and this is violated. That way we can say trend is changed to sideways. Here we have again a drop, two base candles drop. This is also violated because prices went beyond this zone. So that's why we can say the current monthly trend is uptrend. So what we identified from the monthly time frame, we identified prices are currently at equilibrium area. That is one point we observed. And the second point we observed, the monthly trend is uptrend. And third point we observed, the primary price direction on monthly time frame, that is monthly demand zone to monthly supply zone. All these are all positive indicators for bullish trade setup. But is that enough? No. We have to look into even intermediate time frame. What is intermediate time frame? For this is a MIT trade setup. We are planning MIT, monthly income trade. So in MIT trade setup, intermediate time frame is weekly. That is one time frame below monthly. Monthly is a higher time frame. So weekly is intermediate time frame. So let us change the time frame to weekly. So this is the weekly. So we have monthly supply zone and monthly demand zone. In between, we identified weekly demand zone and weekly supply zone. See here, we have drawn on weekly time frame, we have drawn a zone. We have a drop, two base candles and a drop. This is the weekly supply zone. And also we have drawn the weekly demand zone also. We have a rally candle. We have 1, 2, 3, 4 base candles. And then again we have a rally candle. That way we identified a weekly demand zone and weekly supply zone, that is in between monthly demand zone and monthly supply zone. That is what happens. Our weekly zones will be in between monthly demand zone and monthly supply zone. Okay. So what are the things we should identify in weekly time frame? One should be, the primary point should be the trend. So what is the weekly trend? Weekly trend is uptrend. How can we say it is uptrend? Because in the weekly time frame already it is violated several weekly demand zone. So what is the weekly demand zones we have? Weekly supply zones it is violated. There are several weekly supply zones. Drop, base, drop. So this is the supply zone is violated. We have again a drop, base, drop, this supply zone. We have a rally, base, drop, this supply zone. So like that several supply zones are violated. That means at present the weekly trend is uptrend. So that means monthly trend is uptrend, weekly trend is also uptrend. So obviously it is a bullish setup. But apart from that, price direction is also important. What should be the price direction? The price direction should be for a bullish trade setup, it should be from demand zone to supply zone. Where are prices currently? In the demand zone. Which demand zone? Weekly demand zone. So definitely the belief is the pending orders in this weekly demand zone will be pushing the prices up. That means the price direction will be changed. So the moment the prices enters into this area, it indicates definitely the prices will be moving up because the pending orders in this demand zone will be pushing the prices up. So that way we can say the price direction is going to be which price direction? ITF price direction is going to be demand zone to supply zone because it is going to change. The price direction is going to change. The moment it is entering into the zone, it indicates the price direction will be changed. So we can assume because it is going to be changed, we can assume the weekly time frame, that means the ITF time frame, the price direction is also now demand zone to supply zone. That way we can conclude at this point of time. So the primary price direction is from monthly to monthly demand zone to monthly supply zone. Now weekly price direction is also going to be changed to weekly demand zone to weekly supply zone. So in this scenario, definitely we can plan long trades because the trend is in our favor. What about location? Location is also in our favor, but remember we already learned when primary price direction is from monthly demand zone to monthly supply zone and the trend is uptrend, especially the ITF trend. Even though we are taking HTF as a supportive, but ITF trend is uptrend. In that scenario, we need not bother about the location. We can plan trades in low on the curve. We can plan long trades in equilibrium. Even we can plan long trades at high on the curve. Because the primary trend is not yet reached into the monthly supply zone. If prices reaches to the monthly supply zone, definitely price direction will be changed. The pending orders in the monthly supply zone will push the prices down. So that is the reason why we cannot plan long trades at high on the curve. When prices enters into the monthly supply zone. But is the prices entered into the monthly supply zone? No, not yet entered. Still the primary price direction is from monthly demand zone to monthly supply zone. So that is the reason why even if prices reaches into the high on the curve, even before reaching the monthly supply zone, if there is any demand zone, prices entered into the demand zone in the high on the curve. In case if there is any demand zone in the high on the curve, definitely you can plan long trades. That is what I explained earlier. But in this example, the prices are not yet entered into the high on the curve. The prices are at the equilibrium. So anyway, in high on the curve or equilibrium, low on the curve, it doesn't matter because the curve or location doesn't matter when primary price direction is from demand zone to the supply zone. That means traveling from demand zone to supply zone. So that is the reason why the curve doesn't have any significance. So then what matters? The trend. Because the trend, HTF trend is uptrend, ITF trend is uptrend, and the primary price direction is from demand zone to supply zone, and even the price direction at the ITF is also going to be demand zone to supply zone. Definitely, if there is any demand zone in this area, you can plan the long trades. Okay, but in which time frame we have to plan the long trades? We have to plan the long trades in LTF time frame, lower time frame, LTF. So what is the lower time frame? Because this is a monthly income trade, The lower time frame is daily. Weekly is for trend. So daily. So that means you need to identify a daily demand zone for taking your entry and daily supply zone for your target, identifying your target. So let us go to the daily time frame. So daily time frame, already zones are identified. See here we have a ERC candle, and then that is a leg-in. Then we have a base candle, 3 base candles, and then we have a drop candle. So this is the way we have drawn the supply zone. What about demand zone? Demand zone also we identified a drop, we have a base candle, and then we have a rally candle. So that is what we identified. But have you noticed this daily demand zone is inside the weekly demand zone? That means daily demand zone and weekly demand zone are overlapped to each other. Because they are overlapped, can we say it is LOTL concept, level on the top of the level concept? Can we say? What is that you land in LOTL concept? If two zones overlap with each other, we can call it as a LOTL. So here two zones are overlapped each other. So can we say LOTL? So the answer is no. It is not a level on the top of the level. It is not LOTL concept. I clearly told you when I explained about the LOTL. LOTL concept should be applied to the zones within the same time frame. Both the zones should be on the same time frame. If it is a daily time frame, both the zones should be daily time frame zones. But here, what is happening? One zone is weekly zone and another zone is a daily zone. So time frames are changed. Okay, if that is the case, what is this concept? So this concept you are going to learn in our next lesson. Next lesson is specific to this topic. So what is this topic? What is the name of this topic? What are the advantages of identifying such kind of concept? Everything you will understand in the next chapter. So there we will discuss. Now let us limit our focus to our LTF demand zone and LTF supply zone. So this is going to be your LTF demand zone. So prices are nearing to this LTF demand zone. So definitely we can plan a long trade in this zone. But this zone is already tested. Once a zone is tested, can we use that zone for our trading purpose? No, we will not be using if the zone is not fresh. But there is also an exceptional scenario. Previously I told you, we will be learning a concept called high liquidity zones. During our third phase of our training program, you will be learning these high liquidity zones. So high liquidity zone supports multiple tests. According to our software, NeoStock, you know that we have already developed a software. According to that software, this demand zone is a high liquidity demand zone. Anyway, let us don't get into that concept. Because it supports multiple tests, maybe we can plan a trade. Because the trend is in our favor, price direction is in our favor. But can we confirm for our trading? No, not yet. Because you need to learn some more concepts. Now, for trading purpose, it got the eligibility. But final confirmation, you will be identifying after learning few more concepts. Okay. But we got the eligibility as per bullish trade setup. Okay, but what is the risk reward? Previously, we manually calculated the risk reward, right? Now let us, because that experience enough, why I told you to calculate manually, to get very good grip on the subject. That's why I told you do not use any tools. Now it's time to learn some tools, because from next chapter onwards you will be learning some of the risk management related concepts even in the second phase of the training program. So probably your concentration should be not on calculations part. It's better to make use of the tools. Okay, because it is a long trade, TradingView has given, when you want to take a long trade for calculating the risk, they have given a tool called long position. If it is a short trade, TradingView has given a tool called short position. So one of those things you can use, because this is the long trade, let us use. Where to identify this long position? Where to identify this short position? So here we have starting from 1, 2, 3, 4, 5. So this is the place where you identify the tool for drawing demand and supply zones. The same menu, you just click this menu. Here you identified at the top long position and short position. Because currently we are planning the bullish, it is a bullish trade setup and we are planning for long trade. So use this long position. Click on this long position and keep your mouse somewhere here and just click on this. So automatically it is displaying a tool. So it is having 3 dots. Have you observed? 3 dots. The dot below indicates the stop loss and middle dot indicates the entry and the top dot indicates the target. So you need to drag, click there and drag, click your mouse and drag, adjust your target. See here, you can move up and down. So place it exactly at your target level. So this is our target. And the second one, you just, again you can drag, you can click there, place your mouse and click the mouse, do not release your hand and then you drag. Just drag and place at your entry level. Assume this is your entry. So place it there. And stop loss, the bottom one. Just click on this and just drag. And place it at the digital line or a little below the digital line. After learning your stop loss buffers, you will understand where exactly you need to place, just below the digital line. But till then exactly you can keep it at digital line, just little, some points below the digital line. That way you draw. Now you place your mouse on this tool, you will understand, because the letters are very small. If you are watching this video from mobile phones, it won't be visible to you. I am always suggesting you watch the videos from your larger screens, at least minimum a laptop. If laptop screen is also small, I don't suggest you. Maybe you can connect your laptop to your television screen, or if you have a large monitor, connect to the large monitor. Always remember, if you are a trader, always you should have a very good monitor, a large monitor. Never do trading related activities from the mobile phones. Mobile phones should be only in the emergency situation. If you want to be a good trader, always make sure you have a very good monitor so that charts will be visible. Even some of the concepts what I'm explaining, they will be helpful to you. So anyway, what it is showing here, it is showing the below, it is showing the stop loss. In the middle, it is showing you what is the risk reward, and in the top, it is showing you the target value. Okay, what is the risk RR? Here you see risk by reward. Risk reward is 2.3. That means 1:2.3. But we should have a minimum, a 3 or maximum 5 risk will be very much useful to us. So what is the best way? In case if you want to adjust the 1:3, just drag down until the value reaches the 3. See here, now the risk is 3. If suppose if this is going to be your entry, if you want a minimum 1:3 trade, Don't take your trade until prices reaches to this. In this tool, whatever the line is there, until there prices reaches, there only you take an entry. You want 1:5. Further reduce. So this is 1:5. Let me draw a horizontal line here so that you know where exactly you need to take. If you take your entry here, at least you get a 1:5. So wait until prices enter into that. If prices did not reach, don't take the trade because you want a minimum 1:5. That is your requirement, right? That way you can plan. That is one. And another one, you already land the technique instead of proximal 1 entry, you take proximal type 2 entry. See now, I have adjusted to the body till the body. See now the risk is further reduced. Now adjust your entry level here to this. Now you are going to get 1:8. This is 1:8 RR, excellent. Then only you take your entry, type 2 entry. See, risk is minimized and your reward is increased. This is the way you can plan. Or there are other ways you are going to learn in the next chapter. And that next chapter, the concepts, whatever you are going to learn, that will also help you. How further you can change the entry point within the zone. Because your LTF zone is daily. Further we can reduce by using the technique you are going to learn in the next lesson. That way further you can fine tune inside the daily zone. You can find the best entry. How to find the best entry? You will learn the techniques. So these are the different ways how you can reduce the risk. One is your trading view, the long position or short position is going to helpful to you by adjusting until it reaches whatever 1:5 level. That way you can, when prices are really enters into that price level, then only you want to take the entry. Otherwise you don't want to take. Why you want to do like that? Because you want a minimum 1:5 trade. If there is no 1:5 trade, you don't want to take the trade. That is your requirement. To adjust 1:5 trade level, this tool is helping you. See here how we, see earlier our entry is supposed to be like this. After that we change it to 1:3. Still you are not happy with 1:3, you want 1:5. That way we adjusted by dragging until the value comes. Risk reward is now 5.04. That means 1:5 approximately. Basically, for adjusting your risk reward based on that, identifying your entry, this tool will be helpful. Hope you understand the importance of this tool. The primary usage of this tool is from your zone, proximal line to distal line, you can identify what is the risk, what is the reward. See here now the stop loss is 8 rupees. Stop 8 rupees stop loss. In percentage, it is 1.2%. Similarly, your target is going to be 40 rupees. See, your stop loss is 8 rupees, target is 40. So how much it is? 5 times. 8 into 5, 40 rupees. So 5 times reward. That also you need not calculate. This tool is showing here. The middle text. This is the bottom text, this is the top text, and this is the middle text. The middle text, what it is saying? The risk reward. It is 5.04. That means 1:5. Okay, this is about the uses of the tool, long position. Same thing you can do for short position also. Suppose in case if it is a short trade. Let us assume from this supply zone is our short trade. Let us assume time being. So what you do, you go to this tool, you click on this menu, select the short position near the supply zone, just click. Now you drag this. So now adjusted the stop loss. After that you adjust the entry. And you adjust the target. What it is showing, your stop loss is 17.95 rupees and your target is 43 rupees. And what is the RR? It is 2.44. If you want 1:3, what you do? You adjust until you get 3.05. So 1:3. Once prices enter into this area, then only you take your trade. Otherwise, you won't get 1:3. Let me draw a horizontal line here. Assume this horizontal line is your entry. Even though you go for type 2 entry, sometimes type 2 entry doesn't give you enough reward. At the time you need to reduce. How you reduce? With the help of this tool, you reduce. If prices really enter into this blue color line, then only you take trade. If you don't enter and turn back, you will miss the trade. That is what you don't want to take a trade if it is not giving 1:3 RR. The another way you can fine tune is the technique you are going to learn in your next chapter. Okay, first, I hope you understand how to use the tools, long position and short position, how it is going to helpful to you. It is telling you risk reward. First of all, it will tell you the risk reward. And second option, with the help of the tool, you can reduce the risk by adjusting your entry level so that you know where exactly the real RR you want to get. That way you want to adjust. That way it will be helpful. That is the second uses. And third usage is all the manual calculations what you did earlier. That is not required now anymore. Because as part of your training, you already calculated manually. That way you got good clarity about what is risk, what is reward, how to calculate. Because you practiced. So you got a better knowledge. Now no more calculations are required because you already practiced enough. Now you can make use of these tools. That's why during that time I told you not to use any tools. Because initially some manual practice is required. Now this is the time to make use of the tools. And understanding the importance of these tools. Okay. So this is about long position and the short position. And this example is about the monthly income trade. Now let us move on to the next example, sale. This is a WIT. So let us go to, this is a month, in WIT our HTF is weekly. So I am changing the time frame to weekly. So here we are already drawn weekly demand zone and weekly supply zone. This is a weekly demand zone. We have a rally candle and we have two base candles and we have another rally candle, rally base rally. So this is the demand zone. This is the weekly demand zone. And also we have drawn a weekly supply zone here. Weekly supply zone in the year 2011 we identified. So we have a rally, 4 base candles and a drop candle. So from the distal line of this weekly supply zone and the distal line of this weekly demand zone, we have drawn a straight line and then divided into 3 equal parts. So we identified low on the curve, equilibrium and high on the curve. So divide this entire area into 3 equal parts. Okay. So is that enough? No. We should also identify the price direction. We should also identify the supportive trend. Because HTF, we can use the trend as a supportive trend. Okay, what is the price direction? Price direction is from supply zone to the demand zone. Prices are moving from supply zone to the demand zone. That means prices are not moving from demand zone to supply zone. Now price direction, primary price direction is changed. Okay, if price direction is supply zone to demand zone, there are two options here. If it is a bullish trade setup, we can trade against the price direction. Against the price direction, we need to take the help of the location, that is curve. Now curve plays the important role. High on the curve, we cannot take any long trades. Either you can plan in equilibrium or location. But trend should be uptrend in that case, because in bullish trade setup, trend always our friend. So the uptrend. If the trend is uptrend, then in equilibrium or low on the curve, we can plan the long trades. But we cannot plan any long trades in high on the curve because price direction is changed. Which price direction? Primary price direction, that is HTF price direction. So in this previous example, HTF price direction is demand zone to the supply zone. But in this example, the price direction is supply zone to the demand zone. Do prices reach until this area? May not be, because the trend is uptrend. If the trend is changed, then we can expect prices will be changed. As long as the trend does not change, we can accept long trades at equilibrium as well as low on the curve. That is the point you have to observe. Okay, fine. Now we have identified the HTF trend is, what about HTF trend? Is uptrend. Because here, see here, we have a drop, base, drop. It is violated here. We have a drop, base, drop. The supply zone is violated. Probably that way the trend is changed. Even below that there is one more drop, two base candles and a drop. By violating this, your downtrend might be changed to sideways. By violating this, your sideways is changed to uptrend. Even some more zones also violated here. But anyway, currently it is uptrend. Which trend? HTF trend. It is not ITF trend. Our primary trend is an ITF. This is HTF. HTF trend is only a supportive trend. But our primary price direction is a HTF. But primary price direction is changed. But as long as the trend doesn't change, we can plan against the primary price direction if the trend does not change. Which trend? ITF trend. So now let us look into the ITF time frame. So what is ITF time frame? It is going to be daily because it is a weekly income trade. Our HTF is weekly time frame and one time frame below weekly is daily. That is going to be the ITF, intermediate time frame. So let us move on to daily time frame. In daily time frame, we identify two zones, daily zones. We have a rally candle, two base candles and again a rally candle. You may say this candle is also looking like a base candle, but at the hidden body, there is a gap. The moment you add the hidden body, this is a rally candle, and then two base candles and a rally candle. So this is the way we have a demand zone, and then we have a supply zone. Which one? These are all the daily, but this daily is not for entry zones. This is only intermediate time frame. Okay, what is the usage? What is the usage of drawing these demand and supply zones in the intermediate time frame? For identifying the price direction, not for taking the entry. Okay, so here we need to identify two important things. What is the trend? So your ITF trend is also uptrend. Why it is uptrend? Because here it is violated several supply zones. So that is the reason why it is uptrend. So here all the supply zones are violated and finally entered here. Okay, here we identified a supply zone and also demand zone. So now it tells us what is the price direction on the ITF time frame. If you want to go for a long trades, always ITF price direction should be from demand zone to the supply zone. But prices entered into the demand zone. Which demand zone? ITF demand zone. The moment prices enter into the demand zone, see how this demand zone is pushing the prices up. The pending orders in this zone is pushing the prices up. So that means once prices enter into the demand zone, that indicates the price direction is changed to demand zone to the supply zone. When ITF price direction is demand zone to the supply zone, we can plan the long trades. Even if there is any demand zone within this area, still we can plan the long trades. Okay, to understand that, we need to change the time frame. Now we need to move on to LTF time frame, lower time frame. So what is LTF time frame for WIT trades? 75 minutes time frame. So let us change the time frame to 75 minutes. So I'm moving to the 75 minutes. And here we identified a demand zone and also a supply zone, 75 minutes demand zone. We have a rally, we have 4 base candles and we have a rally. This is the demand zone. And also we have a supply zone. We have a rally, 2 base candles and a drop candle. A supply zone is also there. So this is the way you can plan your trade. But as per the risk point of view, risk management point of view, you can plan. Because you have to make sure at least 1:3 RR should be there. If 1:5 is there, that is excellent. Okay, but it is not a fresh zone, it is already tested zone. In tested zone, can we plan a trade? We cannot plan the trades if it is tested zones. But if it is a high liquidity zone, we can plan. How do we know it is a high liquidity zone? Our NeoStock software tells that. Okay, till you land high liquidity zones, you may not be knowing this, but time being, let me tell you, this 75-minute zone is a high liquidity zone as suggested by our NeoStock software. That way, within this zone, multiple entries are supported. So, in case if you want to plan any long trade, you can plan within this zone. But as per our decision making table, it is confirming it is a valid zone. Why it is a valid zone? Because ITF price direction is changed to demand zone to the supply zone. Because we are inside the ITF demand zone. Prices enter into the ITF demand zone, price direction will be changed from demand zone to the supply zone. That way, any long trades, definitely we can plan. But HTF price direction is not supporting. That means we are trading against the HTF price direction. When we can plan HTF against the HTF price direction, there are two conditions. First condition is the trend should be uptrend, so that is satisfied. Second condition is the curve should be either equilibrium or location. Then only you can plan. So where is this demand zone? This demand zone is at the equilibrium. Equilibrium supports long trades. It supports both long and short trades. LOC supports long trades. And HOT supports only short trades, provide trend should be downtrend, and other price direction concepts also should support. But For our example point of view, we are planning a long trade as a WIT, weekly income trade, and a 75-minute zone is there within the equilibrium area, and our intermediate price direction is now supporting. The moment prices enter into intermediate demand zone, now price direction is changed to demand zone to the supply zone. So that way within this 75 minutes, within this daily demand zone, we have a 75 minutes demand zone. In that demand zone, you can plan the trades. Provide your risk supports and other concepts you are going to learn in the upcoming sessions also supports. But as of now, as per the decision making table, this is an eligible zone for taking the long trade. This 75-minute zone is a eligible zone for taking the long trade. Provide risk also should support RR. You should not forget that point. For that, you have to fine tune the zone. How to fine tune? Already you learned one technique with the help of the long position and short position. Next lesson also you will be learning one important concept. There you will learn how to minimize the risk further. Okay, this is about our second example, WIT trade. This is bullish setup. Now we will see one more example for bearish trade setup. POLYCAB, the next stock. And let us go to, this is a WIT trade. Because it is a WIT trade, let me go to the weekly time frame. Weekly time frame, we already identified a demand zone and supply zone. See here we have a demand zone. This is a ERC candle, two base candles, and we have a leg out candle. This is a weekly demand zone, and also we have a weekly supply zone. We have a drop, two base candles, and a drop. And from weekly demand zone distal line to weekly supply zone distal line, we have drawn a line and then divided into three equal parts. One is low on the curve, another one is equilibrium, and another one is high on the curve. And at present prices are at low on the curve. But can we plan a trade at low on the curve? It is depending on the price direction. What is the primary price direction? Primary price direction is from supply zone to the demand zone. Very good. So primary price direction supports, even if trend also supports, that is downtrend. Trend is also a downtrend. But this is a HTF trend. HTF trend is a downtrend. Even sideways also supported. HTF. At low on the curve, definitely you can plan your trades, provide ITF price direction also supports. But anyway, prices are not at low on the curve. Currently, prices are at equilibrium. There is one more candle is there, next candle. Now you see the next candle is there. The candle is there at the equilibrium. Probably if you have a supply zone here within the equilibrium or high on the curve, even low on the curve also you can plan, but prices at present prices are at equilibrium. Probably a supply zone above this only. Definitely not below this. Below this you will identify, you can find only demand zones. Okay, now HTF price direction we identified. HTF trend also we identified. Currently where prices are, the locations also identified. But in this example, location may not be playing any role because of the primary price direction. The primary price direction, that is HTF price direction, is from supply zone to the demand zone. You need not bother about the curve. Curve means location. Okay, now let us go to one more time frame below, that is intermediate time frame. So one more time frame below for weekly is daily. So daily is the intermediate time frame. So what is the daily trend? Daily trend is a downtrend, definitely, because there are so many demand zones, it is violated. So this is the first demand zone violated. And this is another demand zone violated here. Drop base rally. And here rally, base rally. This is another demand zone violated. So multiple demand zones are violated. So definitely the trend is changed to the downtrend. So already we have seen on HTF time frame trend is down. On ITF time frame is also the trend is down. Then what about the ITF price direction? For that we need to draw the ITF demand zone and ITF supply zone. So ITF supply zone we have seen, we have a drop, base and a drop. If prices enter into this, the price direction will be changed. But what is the demand zone? Here we have a demand zone. Rally, base, rally. See here. The visual representation is changed due to the previous candles. We have a rally, base, rally. Don't compare this candle with a leg-in candle. There is no rule that a leg-out candle should be greater than leg-in. There is no rule. Leg-out should be an eligible candle. Compared to the previous candles, it should be a large candle. Still, if you are not convinced with this leg-out candle, you can draw your zone like this. This is also possible. Because I am convinced with this candle as a leg-out previously. So I have drawn like this. In case if you are not, your zone will be like this. But anyway, you have to fine-tune the zone. That is a different story. So prices entered into this zone. Now what happened? Price direction is changed. Which price direction? ITF price direction is changed. ITF price direction is now demand zone to the supply zone. When ITF price direction is demand zone to the supply zone, can we plan the short rates? No, we cannot plan any short rates. Only if ITF price direction supports, then only we can plan the short rates. That means, are we doing a wrong analysis? That you will understand once you look into LTF zone. You may ask a question, why we should go to the LTF zone? First of all, ITF itself is clearly telling it is from demand zone to the supply zone, not supply zone to the demand zone. So why should we look for ITF? We can reject this, you may say. That's why it is an important example. There is one important point you are going to learn from this exercise. Why I am saying we have to go to the LTF? You will understand now. Finally, after looking into the LTF only, you have to take the decision. Okay, now let us go to the LTF time frame. What is LTF? 75 minutes. Okay, in 75 minutes, we identified a demand zone. We have a drop, base, rally. And what about supply zone? The supply zone is there inside the ITF supply zone. LTF supply zone is there inside the ITF supply zone. What is LTF? 75 minutes. What is ITF? Daily. Our 75 minute supply zone is there inside the daily supply zone. If that is the case, what will happen? What will happen next time when prices enter into this? The meaning is the prices entered into ITF supply zone. Once the prices enters into the ITF supply zone, the price direction will be changed. What is going to be the price direction? The price direction is going to be supply zone to the demand zone. Once the price direction is supply zone to the demand zone, can we plan short rates? Yes, we can plan. Which supply zone we have to plan? The LTF supply zone. The LTF supply zone is there inside the ITF supply zone. See here, we got two advantages. One thing is LTF entry we got, and the second one is the ITF price direction is also changed. That means ITF price direction is in our favor. Already HTF price direction is in our favor. Now ITF price direction is also going to be in our favor. When such kind of advantage we get, when LTF supply zone is inside the ITF supply zone, in such kind of situation, we will get that kind of favor. The price direction changes, automatically the trade also will be enabled, the short trade also enabled. Both things are happening at the same time. That's why this is a special scenario. That's why I asked you in the beginning of this session, is this LOTL concept? So the answer already you learned no, because the time frames are different. Then what is the name of this particular concept? That you will learn in the next chapter. That's why I told you this is a very important topic. See how this topic is helping us. This topic not only changed the price direction, immediately it enabled the short trades also. See the advantage here. That's why this next topic is very, very important. At some point of time, the moment when you looked into ITF time frame, that is daily. See, this is the daily. When you are analyzing the daily, you haven't analyzed the LTF. So that's why there is no LTF zone here. After analyzing ITF, you go to LTF. The moment you looked into this ITF, intermediate time frame, the price direction is demand zone to supply zone. It is giving an impression. What kind of impression? Because price direction is demand zone to supply zone, we cannot plan any short trades. Theoretically, that is correct. You should not plan short trades when price direction is from demand zone to supply zone. But when you can plan the short trades, when price direction is changed from supply zone to the demand zone, you can plan. That kind of clarity we got the moment we shifted to 75 minutes. Our actual supply zone is there. Which supply zone? LTF supply zone. Our entry time frame supply zone. Our entry supply zone is there inside the ITF supply zone. So that is the reason why immediately prices enter into this ITF supply zone. At the same time, prices are also entering into the LTF supply zone because both are overlapped. And the advantage we got, the price direction, ITF price direction is changed to supply zone to the demand zone. When supply zone to the demand zone price direction is changed, immediately short trades are enabled. And exactly same place, our LTF supply zone is also there, the 75-minute supply zone. That means we can plan a short immediately. Why we can plan a short immediately? Because the ITF price direction is supply zone to the demand zone. HTF price direction is supply zone to the demand zone. And even location doesn't significant still. Our location also high on the curve. That is excellent. We are in the sellers area. Even though that is not having any significance, still we can say it is a sellers area. That is at least some added advantage for us. And the ITF trend is downtrend. HTF trend also, supportive trend is also a downtrend. When we have so many positive factors, why can't we plan a trade? And moreover, this zone is a fresh zone. But when it is possible, if prices enters into this, are the prices are going to enter into this? We don't know. This is only a trade plan. We are assuming prices will enter. The other things will happen. Somewhere here, a new supply will be created again. They may turn back. That is also possible. Again, somewhere here, a new demand zone will be created. Prices enter into this. That way, our RR might be disturbed. Maybe this is a eligible zone, but it may not be confirmed if there is a poor RR. Zone got the eligibility for short purpose, but we may not be confirming because if there is a RR is not good. There could be other reasons. So due to that, this is the reason why always we need to look into LTF time frame and then we need to take a decision. If you would have taken a decision in ITF time frame itself, let us reject this stock. See, you might have missed a very good opportunity. If prices really enter into this zone in next few days, definitely a good opportunity we would have missed. Actually, we are able to see this, even though at present the direction is demand zone to supply zone, the moment prices enter, immediately price direction changes and also immediately short trades are enabled. That particular point we would have missed. That way we missed a very good opportunity. Hope you understand. That's why a zone, one time frame zone is overlapped with another time frame zone is a very, very important concept. In such kind of situations, your price directions will be changed and your trades also will be enabled. So what is this concept? So this is what you are going to learn in the next chapter. That is zone confluence. The next chapter is zone confluence. So what is zone confluence? And what kind of advantages we get by doing this zone confluence? That everything we discuss in detail in our next lesson. I hope this practical lesson is helpful to you. We have seen two important income trades, that is a monthly income trade and weekly income trade. You might ask a question, why can't we see examples related to daily income trade and hourly income trade? Maybe you can say this is an exercise to you. Or still you want examples every day in analysis discussion. Whatever the examples I am explaining every day, each day. The high liquidity zones I am explaining. All those trades are either DIT trades or HIT trades. Daily income trade or hourly income trade setups. Everything. Because of the high liquidity zones are either daily high liquidity zone or 75 minutes high liquidity zone. High liquidity zones we use as a HTF zones. That means your daily zone is a HTF. That means it is a DIT trade. Or your 75 minutes high liquidity zone is there. That is a 75 minutes HTF zone. That means that is a hourly income trade. We have plenty of examples every day. So that could be one reason why I didn't focus on those examples. Primarily I focused on WIT trades and monthly income trades. There is also another reason is also there, because there are people who are learning our course. They didn't have enough time to participate in short-term income trade. They can participate in swing trading. They can hold it for few weeks or few months. Already some of our members requested examples, and I promised them we will be discussing those trades after completing our course, the second phase of training program. The reason why I promised is because today's practical session is very important. First, you need to learn these concepts, understand these scenarios, understand the practical problems. See today how we have seen the price direction. At one point of time, we are in a we want to reject the stock, but when we go to the lower time frame, we got the clarity. We should not reject the stock. The last example I am referring. So when you understand these kind of scenarios, minute level concepts or minute level points, then you get better clarity. So once you learn, then we can discuss these examples in detail. So few more concepts after completing, definitely I will be explaining some of the zones generated by our NeoStock software. By using them, how we can plan WIT trades or monthly income trades, MIT trades. Okay, hope this information in these practical sessions are useful to you, and also you learn two TradingView tools, long position and short position. Please practice by making use of those tools. They are very, very helpful because we are nearing to completing our second phase of our training program, probably in another 1 or 2 weeks. We are supposed to complete in the month of December, but we are delayed by a month, mainly because of price direction. Actually, I am supposed to explain price direction in third phase of our training. That was my earlier plan. But the reason why I introduced is I don't want to split the topic, the important topic, and move on to the third phase. Because this is an important topic, and this will identify your trades in a much accurate way. So I thought it is the time to learn price direction in second phase, because I haven't finalized the rules price direction. Because in earlier my plan is I thought of taking it in third phase. So almost 2.5 weeks time is I spent only for finalizing the rules related to this topic. So that way we are delayed. But anyway, delaying is not a problem, but learning in a perfect way and accurate way is more important. And learning the right concept at right time, at right phase is important. So if you are having any questions, please put them in the comment section related to this topic. I will try to answer. If anything is required, I will try to prepare another video related to your questions. Hope this information is useful to you. Let us all meet again in our next chapter, Zone Confluence. Thank you.